Welcome to the daily update. This is being prepared Friday, August 12th, where we'll look at the action in the market today and then see how things look for Monday, August 15th. And it was a positive day. We broke through some resistance. A lot of our scenarios are still playing out just fine. The market was pretty much up across the board, and this is usually what happens. This is how I analyze things. When we're going up, I start to look for problems. When we're going down, I start to look for positive things. Well, there's a few problems that I'm starting to see, and I just want to make you aware of those in this video. So let's go back and talk about what happened on Friday. Right at the open, we had a gap higher, and the sentiment report came out, and it was better than expected, and I'll show you a chart of that. But the market kind of had some momentum going through the night with the futures contract, and we opened above the daily pivot at 42.22, which is kind of interesting because that was a pivot point in Thursday's session. You see how these things have a tendency to work out with each other. Prices then broke above R1 at 42.43. We never made it up to R3, but we still were able to get above R1. Prices then advanced to R2 at 42.80 and actually stayed right at about that level. We ended up closing at the high. We were up 1.73%, a nice healthy gain, but volume really dropped off on a solid up day. But that's more or less what we've been seeing overall, is a real drop off in volume. And the technicals, they're still looking positive, but we're starting to get into more of a short term and even slightly intermediate term overbought situation. Doesn't mean we can't stay here for a while. We can still even go a little bit higher than this, but we have some pretty significant overhead resistance now that we broke through some resistance that hopefully will become support if we start falling back. But now we have some even bigger resistance ahead of us. Inflation and interest rates are the real fixation, which is producing growth concerns. And the scenario that we're starting to go with is that maybe inflation has topped out and it's starting to come down. We had that happen a few weeks back, and that was a false alarm. We're starting to see that again. Will we see a continuation of that? Now, the employment report is not necessarily suggesting that, but in most of the other economic reports that we're seeing, yes, it is suggesting that the economy is slowing down a bit and inflation is starting to come down as well. We have the whole list of geopolitical concerns, which just keeps growing by the day. And these are just the main things that might have an influence on the market. There's a lot of other things that I don't list on here. Earnings reports are still coming out. And then we have the recession. Are we, aren't we? What is a definition? What is it not? Going back and forth. So what are some comments? The S&P has now retraced over 50%. So we were at the all-time high in January. We hit the lows in June. We've now retraced more than 50% of that decline. That's fairly positive. And we're actually above that a little bit, according to my charts. That was one area of possible resistance. And at least based on what I'm looking at, we've closed above that. All of the sections were up in Friday's session. The sector rotation and the positive setups, they're still looking okay, but they're starting to lag a little bit. And this is one of the concerns, and I'll show you that in the chart. It's a slight negative divergence that we're seeing. We're having up days, but the rotation charts are not really spiking up as much as maybe you would think they should. Now, this could change. This is just what I'm seeing right now. They were holding up better as we were going down, but when we have up days, you'd like to see them advance a little more than what they've been doing. But this was a pretty much across the board advance on Friday. So that might be a little bit of the explanation for that. The 200-day simple moving average, that's the big one. That's what most investors use. That's the line in the sand between positive and negative. That's still above where we're at. And as we get closer to that, unless we go sideways for a while or have a few days of declines, if we still keep advancing, we're becoming more and more overbought right when we get to overhead resistance, if that is what ends up happening. We still have the 10 to the 2 and the 10 to the 5 yield curves. They remain inverted, and fear is still neutral. It's tipping a little bit. It's around 55 right now, so a little bit into the greed area, but I'm still calling that neutral. And when we had consumer sentiment that came out, and the preliminary report came in at 55.1. Now that's still very low in and of itself, but they had expected it to be at 52.1. So that was better than expected. And it's starting to bounce up from the extreme low reading that we did see last month. Import sales also fell 1.4%. That kind of ties a little bit into the inflation area. Import prices, when you take out oil, they fell 0.5%. Export prices fell 3.3%. And if you take out agriculture, they fell 3.3%. So we're seeing a decline right now with some of the inflationary things that we pay attention to. Our trend is still positive. The ADX is above 20. The green line's on top. I'm keeping the bias as positive because we had an up day. The momentum is also positive. Even though we had a number of down days, they were small down days on a closing basis. So I went ahead and kept the momentum as mixed to positive. Well, with Friday's advance, I'm switching that back over to positive. Let's go back and look at the day's session where we're at 55 right now, just leaning on the right side of neutral. And we're kind of in the middle right now. Now, one thing that I want to just say really quickly is that, yes, we tend to use this as a contrary indicator, but only at the extremes. I think a lot of people get this a little mixed up when they're saying, okay, well, sentiment's going up, we should be going short, or we think the market's going to go down. That's not necessarily the case. When we're showing an extreme fear reading, that's when we're looking to go long. When we show an extreme greed reading, that's when we're looking to go short. But as this thing either advances or declines, we can follow that because that's the way most people are feeling at that time. So I hope that clears up any questions that some of you may have had about that. Here is sentiment. We still have a really big spread between the 2-year Treasury yield, which is the red line, and consumer sentiment, how people are feeling, but it did bounce up slightly overall. So this is seeing that people are getting a little bit more hope right now. We also have some Isabel net charts. This is the headline versus the core CPI inflation on a year over year. This is just a projection where they're thinking now with both the dark blue line and the light blue line that maybe we've topped out and now we'll start coming down. Who knows? This is just what the Bureau of Labor and Statistics, supported by Bank of America, that's kind of the scenario that they're going with right now as far as a forecast. We have to wait until the real numbers come out to see if that will change. This is looking at the top. It says big money selling needed for the big low. Well, we're seeing the household equity flows really going up. They're spiking up. People are putting money into the market according to this chart, and there's really no outflows as the S&P has been going down. What we would see according to this chart that would be more healthy is with the S&P, the gold line here, hitting a bottom, and where the flows are actually negative, which means people are taking money out of the market. And we're seeing kind of the opposite of that right now. So this could be a little bit negative. People are saying, oh, it'll come back, it'll come back, it'll come back. You need to pretty much wipe that off the table before you truly hit some kind of a bottom. And this chart suggests that we have not hit that bottom yet. We also have just looking at the bull versus a bear market, and there's a debate going on about this. Now, a secular bull or bear market, that can go on for years, if not decades. There's some people out there that say we are still in a secular bull market. But what we've seen in 2022 is a cyclical bear market within a bigger bull market. Okay, I just follow the charts, but this is showing since we hit the lows back in 2009, according to this chart, we are still in a bull market, but there have been corrections along the way. Are we going to come all the way down to this line? Now, we may do that. We're not doing that now. But this could happen at some point in the future if things really start to turn negative. If we see companies consistently readjusting their earnings to lower estimates and then lower actual results when they come out, that's ultimately going to drive things lower. If interest rates still continue to go up, that bites into earnings as well, and that could drive things lower. But at least right now, things are still looking quite positive. This is showing that people are getting back into tech stocks. I showed this chart a few days ago where we were just starting to show some positive movement into tech. Well, now the moving average, the dark blue line, it's starting to turn back up as well. And this is what people think of when they think of growth. They get into tech stocks. Then this is the proportion of firms that are mentioning recession when they have a conference call after they release their earnings. It was up to 30% during the COVID plunge. It's now up to, it's dropped a little bit, but it's at 18% right now. So that's what these firms are saying. Regardless of what definition you want to use, these are what the people are saying when they release their earnings reports. And then down here, it's the ISM Manufacturing Index, where it's also showing a bit of an advance. Will that start to roll over now that inflation and a recession is being stated more often? Then we had the active asset managers. They really spiked up. They're up to 71.59. We're getting into kind of a bullish area now, but not necessarily an extreme reading. Then this just kind of shows the scenarios that are going back and forth. When you show the probability of a 0.75% hike at the September meeting, well, after the jobs report came out, that was really strong. So we poof, oh yeah, they're going to raise interest rates. Then we danced along sideways for a while. Then the CPI came out. Whoops, that was better than expected. Boink, now we're down to here. And that's kind of the tail that's going back and forth depending on which economic reports are coming out. Then we also have and I'll show this more in the weekly video. That's when I usually cover the intermarket stuff. And in the intermarket analysis video, where copper has been showing kind of a nice rebound right now. And that tends to be a barometer of the economy. If copper is going higher, that generally means that the economy should be improving into the future. If it's going down, we see the opposite of that. All right, let's look at the sectors where for growth, large cap growth, we were up 1.99%. That's pretty good. Value was up 1.41%, and we were up across the board by and large. The VIX has now dropped below 20. That's usually when we get more to a complacent area, but this still could go a lot further. When we get down to 12 or so, that means pretty much that nobody is hedging at that point. But those are static numbers, 12 for the low, 20 for the high. It used to be when we broke above 20, that's when everybody was freaking out. Well, you can see we go a lot higher than that these days. But we try to look at this also on a relative basis. That's why I have the moving averages on here. But fear is starting to come down with the S&P. We're a little bit sideways to slightly up with the VIX of the VIX, and we're right at the underside of the moving average with the line chart. The Ulcer Index, this is showing that there's really not much fear. Here's the weekly chart showing how fear has been declining, but it still exists, and that lines up better with our sentiment charts that we're looking at. We're down 11.17% from the all-time high. We had the low back in June, and we've gained a really nice, 13, 14% from that low that we hit back in June. Equity put call ratio on a one-day chart continues to decline and is also declining on the 5-day or simple moving average chart. Here are the support and resistance levels, or the pivot points, I should say, for Monday's session. If you use those, and I use them heavily, you can just see how we went right up to R2 and stopped right about at that point in Friday's session. Here's the daily chart where we're slightly above R1. That is positive. We still have some long-term resistance above where we're at. And if we do, for some reason, break through that, now we have the moving average. Now we have a declining trend line, and there's just about on top of each other. And that could provide some pretty significant resistance. Doesn't mean we won't break through that, but it might take some time for that to end up happening. And if we continue to go up like we have been, by the time we get to this area, our indicators are going to be quite overbought at that point. That's just one thing to be aware of. I'm not saying that's what's going to happen, but if we do see these advances, that's what it could end up being. We might chop sideways for a while. We might decline a little bit. We might go down and see, is this R level really able to hold? Doesn't mean that we're just going to go straight up there, but you never know. Stranger things have happened. Here are the monthly pivot points with the updated bars. And then our fib retracement, we're coming right back slightly above the 50% retracement from a low set back in 2021 to the all-time high. Well, I don't have a chart of this, but if you go from the all-time high to the low set in June, we've also retraced about 50% of that. And I'm sorry, this is a 61.8% retracement on this chart, but we've recapped about 50% of what has been lost in 2022 so far. This also shows that we are just slightly above some resistance going back to the COVID low to the all-time high. We also have another low set in 2020 to the all-time high, and we're breaking through this resistance. And that is pretty positive right now, but we still have lots of other resistance on other charts that we have to deal with. Our sectors, all of them were positive, with discretionary in the lead, followed by tech, and then materials, communication. It was just a strong day across the board. Energy was up, but it performed the worst in Friday's session. Here are the technical analysis scores with utilities, energy, and industrials. They're into the 90s. Communication has now got up into double digits at 11.9, where it had been in single digits. And here is the sectors chart showing energy is starting to go back up slightly. Utilities are still holding up. All of the other sectors are negative, but showing some improvement. This is the indexes going back to the all-time high, with the Dow being down the least, the NASDAQ 100 and the NASDAQ, they were down the most since that all-time high. We had some technical alerts. Canada still doing a little bit better. The NASDAQ dropped below 12.8, then it got back above 12.8, then 12.9, then 1300. The dollar saw a bit of a bounce and it got back above 105. Some of our sectors are starting to show some positive signs there as well. So technically things do look like they're improving. All right, so we had the gap higher right at the open above the pivot. That's this dark blue line. And we just kept going higher. We stayed along R1 for a little while, broke up above that, went all the way up to R2, and that's where we closed on the day. So that looks pretty healthy. Our trend saw a little bit of a decrease with the buying, which is strange on an up day, but we're still in an overall uptrend with the ADX advancing and the green line is on top, and the selling pressure is decreasing. The Arun shows that the buyers are in control and selling is starting to drop, so our oscillator continues to advance. Looking at breadth, we saw a really strong breadth up day, and so based on price, we saw it really shoot up. This is encouraging too, where volume was able to break slightly above the moving average. Even though the moving average is still declining, if we can stay above that, that would be a lot more positive. Advanced decline ratio starting to look extreme positive. New highs, new lows also continue to advance, not really breaking out as much as you would think they would. We would want to see these green histogram bars be a lot higher than they are. That's not a histogram. Yeah, I guess it is a histogram. But these green bars, you'd like to see them be a lot higher, but they're still advancing anyway. Accumulation distribution is advancing and above a rising moving average. Short term, the decision point made a change in Friday with their intermediate term. They're pretty much bullish across the board now. We still have the long term in a downtrend. We're back to looking at the advanced decline ratio. It spiked up after Wednesday, came back down on Thursday. Well, it spiked up again after Friday's session. On a very short-term basis, that means we kind of maybe overdid it. Then we're starting to come back up to the underside of the 200-day simple moving average. We're above all of the other moving averages now, and they're starting to turn up. What's going to happen if we reach this level? Are we going to bump into that and come back down? Are we going to be able to break through that and get above all the moving averages? That's what we'll be watching for. And right now, this moving average is at about 43.29 or so, but it readjusts every day slightly. The rate of change going back 20 periods, or roughly 1 month of trading days, this is looking a little extreme positive. The Stochc RSI is extreme. The Williams percent R is extreme. The Force Index is not extreme, but showing in advance. The Swinland Trading Oscillator is showing in advance based on price and volume. McClellan Oscillator looking a little topsy right now, but it could even go higher than this, but we're starting to see this in a lot of our short-term charts. 20-period moving average looking pretty extreme. Even in the 50, this is more intermediate term. It's starting to look a little high. See, we haven't got to this level in quite a while. The 200 still continues to advance. Stochastics, these are pretty much extreme across the board right now. So that's another kind of warning sign, but it doesn't mean that we're just going to turn around and go down. We could stay up in this area for quite a while with any one of these charts. Intermediate term, the Sean trend meter, it was kind of flat on an up day, which is a bit surprising. That's one of the negative divergences that I saw. The PMO continues to advance, but it's starting to look extreme, but we're still advancing based on price and volume. So this is looking just a little topsy overall. The PMOs that are rising, yeah, spiking up positive, but looking a little extreme. We're turning up with the buy signals. We're starting to get a bit extreme with the percent of PMOs that are above zero. Chaikin oscillator, this is another negative divergence. We've been going up overall with our bars, but the Chaikin oscillator has been going down. And this tends to be pretty sensitive to price action. So it's picking up something that it really doesn't like right now, just to be aware of this. Chaikin money flow also showing a little bit of a decline, even though it was up and it's positive. It's showing the last couple of days where it's fallen off a bit. We're really seeing a drop off in volume. You want to see good, healthy volume on up days. That shows a lot of conviction. We're not really seeing that right now, but we haven't really been seeing that all summer. The vortex continues to be positive. Summation index based on price and volume, also positive. The slope, it's right on top of the moving average right now, so it's a little iffy, but all of our other oscillators continue to be positive. But here, look at the KST starting to get a little extreme. The tricks, a little extreme. The PMO on the other chart that we looked at, a little extreme. The TSI looking a little extreme. So we just want to be aware of this. The BPI, it was up, but didn't really shoot up all that much higher, even though we were kind of breaking out on a price basis. So this could be a little overextended. Ease of movement turned up slightly. Ultimate oscillator, also not extreme, but did turn back up. Here's our longer term moving averages where we're coming up to the underside of the 200 right now. Can we get above these and then stay above these moving averages? And I think I have the same chart later. The money flow index is also looking positive and not extreme, but the CCI 14 and the CCI 20, they are extreme right now. RSI starting to look extreme with both the 14 and the 9 period. Now they could go higher, but we just want to be aware of these things. Here's an indicator I haven't shown in a long time. I was showing it when we were going down, but this is the boom indicator. This is how far away are we getting away from the 50 period moving average. We're starting to move away from that pretty quickly. And a lot of times this will signal some kind of a top. Where the 200 period moving average, we're starting to show some improvement, but we have yet to really break above the 200. This is another one I haven't shown in a while. This is the 19-day exponential moving average of the advanced decline line. It's starting to look a little extreme positive after going extreme negative. So yeah, it's positive, but we're seeing a lot of things starting to come together that we just want to be aware of right now. TTM squeeze still looking positive with the 200 period moving average looming overhead. Our different charts, Heikin Ashi still positive, Kegi positive, Renko positive, 3-line break positive and drawing new bars. Nothing new on the point and figure chart. It's still going off the triple top breakout, but that is still positive overall. We still have the blue line underneath, which is signaling an overall long-term uptrend. The elder with the S&P has gone back to positive as it has for the SPY. SAR continues to be positive with the dots underneath. Go, no go, also positive. Now, long-term, this is the other, well, it's the same chart. I meant to show a different moving average rainbow chart, but I had the wrong one there. But still, can we stay above these moving averages? 50 period looking a little toppy now. 150 still going up, 200. So longer term, we're showing some improvement, but we still haven't really got above that 200-day moving average. The special case starting to turn up. Broad market, the diamonds positive. Here's the Dow also coming up to R1 and just closed right below R1 with the 200-day right above where we're at. The Qs also turned back to positive. we are slightly above R1. We still have a ways to go to get back to the 200-day moving average. So I would be watching the Dow and its 200-day moving average, keeping an eye on the NASDAQ. See, that's why we watch all these things at the same time, because this is where we're getting a lot of our growth thrust from. But the Dow is also very important to watch. Here's the Vixen, which just is showing how it's been declining, both on the line chart and on the bar chart. Here's the NASDAQ above R1, but still has the 200-day moving average above and another resistance level before we get there, if we go there. Mid caps right on R1, just barely above the 200-day moving average. That's positive. Can we continue to see some strength from mid caps? Wilshire also above R1, but has not been able to get back to the 200-day moving average yet. The dollar bounced up about 0.5%, still in an overall uptrend after seeing some weakness recently. That was another interesting thing. Stocks were up and the dollar was up at the same time, which is kind of different than what we've been seeing lately. Here is the correlation where they're still having a tendency to go in opposite directions, but that relationship is not as strong as it was. Gold was up almost 1% and has kind of been hanging in there recently. Silver was up 2.68% and is back above the shorter term moving average, but we're still in an overall downtrend. Oil fell a little bit down to 92.09. The correlation between oil and the S&P, they're neutral right now. We're right in no man's land. Bonds were also up almost 0.5%. That would be really healthy to see bond prices going up and stocks going up together, which would bring down interest rates. Here's the World Bond Index, also was up 0.21%. Here's the stock to bond correlation. They're starting to kind of wear off a little bit, but they're having a tendency to go in the same direction. And then our yield curves that we look at, the 10 to the 5 is still inverted. The 10 to the 2 is still inverted. And we're keeping an eye on the 10 to the 3 month. It has not gone inverted yet. We're just waiting to see if that will happen. Then the tech sector to the 10-year, they're having a tendency to go slightly in the same direction. And then we're just seeing a real mishmash, lines all over the place here, like 6 EKGs of people watching a sporting event all at the same time, where longer term in the 30-year it went up, but the 10, 5, and 2 all came down, and we were pretty much flat with the 3-month. So our scenarios still holding up with those stocks above their 200-day simple moving average. That's turning out to be a nice signal so far. What we're watching for now is, has this signal run its course yet? Is the resistance that may be above us, if we even get there, is that when we're looking for this move to at least pause? Or if we break through with any real conviction, can it keep going? We're also seeing a little bit of a topward movement here with these S&P stocks above their 50-period moving average. That's looking a little spiky. And you can go back, and when we hit high points here before, sometimes that marked some kind of a high, usually shorter term with the S&P. But we're still seeing it advance with the mid caps and the small caps, and they are not extreme yet. The 10-day average of the highs on versus lows in the S&P still starting to advance. Looking at the real broad market with the Amex, NASDAQ, and NYSE, this is still advancing right now. The equity put call ratio, after spiking up, still continues to decline. That was another positive setup that we've been working off of. Small cap index slightly above the 200-day moving average. So you see what's happening here? The small caps are, at least for right now, they've regained the 200, and the mid caps have regained the 200. Now we need to see, can the large caps, can the Dow, can the NASDAQ, can the NASDAQ 100, can they go back and recapture their 200-day moving averages as well? So in the ratio basis, we're still seeing small caps up slightly. And here's the spike that we're looking at, which often gives support to the S&P. So far, that's been working out. Can it continue? Here's S&P to the 10-year yield. They're having a tendency to go in the same direction. Also, Copic curve almost ready to wipe this signal off, but it's been a valid signal. It crossed over not too long after hitting that low back in June. This is what's a little bit concerning. The Qs had a good solid update, but see, we didn't really go up all that much. We're still positive. And discretionary, it turned up a little bit. And growth versus value, it just turned up a little bit. You might have expected this to turn up a little more than it did. So we just want to keep an eye on that. Here's the large, mid, and small cap growth to value ratios showing a little bit of a turn up with the large caps, actually a bit of a decline with the mid and small caps. Want to keep an eye on this. The correlation between the 2-year yield and the S&P, they're kind of going more in the same direction. We still don't really know, is this a valid spike right now? So this isn't a real strong setup. At least it hasn't been for a while. The staples were up 0.87. They're above both moving averages. Are we going to cross back over and give us a golden cross? But this continues to fall. This, to me, is the most powerful signal that we're working off of right now. We're spiking up, and this is going down. We've actually broke below where we've been at before. So that's looking like a valid signal. All right, so our outlook then, the technicals are positive, but they're becoming overbought, specifically in the short term, and even a little bit in the intermediate term. And we still have the 200-day simple moving average above where we're at right now, whereas the small caps and mid caps have already been able to get above that. Sentiment is still pretty much neutral now. We have the Empire State Manufacturing Index, not a real biggie, but some people cite it because Empire State, that's New York. That's a huge city, so that might have some kind of influence. And we have the NAHB Housing Market Index coming out. We've got the whole list of geopolitical events, which right now, in case one of these things you see here comes to the top, the markets are still really worried about inflation and interest rates. All right, so our scenarios. Are we going to go down from here? Well, we could if some of these headwinds really come into play, and the S&P is becoming overbought with overhead resistance. That's one thing to be aware of. That could push us down slightly. Not so much to turn us negative, at least at first, but we'll want to keep an eye on that. The technicals are positive, so we would be going against the trend. We are in an up scenario now because the technicals are positive, but they're becoming overbought. You still have a real disbelief. Now, let me tell you what I think might happen here. If we get up to that 200-day moving average with the S&P and we go a little bit above it, that's going to be the trigger for millions of investors to get in. That's kind of what happened. We didn't, not the same scenario, but last March when we topped out, everybody said, okay, no, I'm going to jump in. That was the top. Is that going to be what happens this time? If we get slightly above the 200, folks jump into the market, which are not necessarily the smarter investors. Are we going to hit some kind of a top at that point? Or will we be able to get some thrust and keep going up after that? Because if we go above that 200-day moving average, FOMO is going to kick in, the fear of missing out. And the fear of missing out often leads to the reality of losing out because people tend to react kind of late. All right, our scenarios, they're still okay, but we're seeing some little divergences here just to be aware of. The technicals are still positive. We still have the 200-day simple moving average above us, and then other resistance levels or even support levels if we fall. We're not neutral right now because the ADX is still above 20 and it's positive. So our conclusion, the S&P is positive, but it's becoming short-term and intermediate-term overbought, especially if we continue to advance. Short-term, we're overbought. Intermediate-term, positive, but could be becoming overbought. Long-term, as long as we're still below that 200 simple moving average, we are still negative overall. So thank you. Have a wonderful weekend. I will be preparing the weekly video and the InterMarket analysis video over the weekend as well.